A school teacher and a billionaire can make the same amount of money in a year, and the teacher can end up paying a higher tax rate. Not because the billionaire broke the law, because he read a different rule book, one that was sitting in plain sight the entire time. The wealthy don't have a secret accountant with a magic button. What they have is a completely legal understanding of how the tax code actually works, and it's built on one idea almost nobody ever teaches you. The tax system was never really designed to tax wealth. It was designed to tax one very specific thing. And if that thing is how you make your money, you are playing this game on the hardest possible difficulty. So today I'm going to hand you the rule book. 3 legal levers the wealthy pull and exactly how you can start pulling them too. Let's be clear about what this is and what it isn't. This is not tax evasion. Evasion is lying and hiding. It's illegal and it will land you in prison. This is tax avoidance, which is simply using the rules exactly as they are written, and it is something every accountant on earth does for their clients every single day. Now here's the single most important sentence in this whole video, so let it land. The tax code punishes earning and it rewards owning. Your paycheck, the wage you trade your actual hours for, is the single most heavily taxed way to make money in the entire system. Meanwhile, the money that comes from owning things, businesses, stocks, real estate, is taxed far more gently and sometimes not at all. The middle class earns wages. The wealthy own assets. That one difference is most of the whole story. So let's break down exactly how they use it, one lever at a time. Lever number 1. Change what kind of income you have. When you earn a paycheck, the code calls that ordinary income, and it's taxed at the highest rates there are, climbing well past 30% for high earners, and that's before payroll taxes even get their cut. But when you make money by owning an asset for a while and then selling it, that's called a long-term capital gain, and it's taxed at a dramatically lower rate, often just 15%. Sit with how strange that is for a second. A surgeon working 100-hour weeks for a high salary can pay more than double the tax rate of an investor who made the exact same amount by simply holding a stock and doing nothing. So the wealthy arrange their entire lives to be paid in assets instead of wages. The founder takes a tiny salary and a mountain of stock. The investor lives on capital gains and dividends. They deliberately move their income out of the high-taxed wage column and into the low-taxed ownership column. Same number of dollars, sometimes half the tax. Here's what that looks like in real life. A tech founder pays herself a modest salary, taxed like anyone else's. But her actual fortune, the hundreds of millions in stock, just sits there, growing, taxed at the gentle capital gains rate only if she ever chooses to sell. Her wealth and her taxable income are two completely different numbers. Yours are the same number. That is the entire gap, in one sentence. Lever number 2. And this is the big one, the one that makes jaws drop. Change when you get taxed. Here's a rule most people never stop to think about. You are not taxed on an asset while it grows. You are only taxed when you sell it. Your paycheck gets taxed the instant you earn it. But a stock that quietly triples or a building that doubles in value is taxed only if and when you actually cash it out. So the wealthy figured out something almost elegant. Just don't sell. If you never sell, you never trigger the tax. But then how do they buy anything? How do they fund the mansion and the yacht? They borrow. They walk into a bank and take a loan against their enormous pile of assets. And here's the quiet magic. A loan is not income. Loans are not taxed, so they get real, spendable cash, completely tax-free, while their assets keep growing untouched behind that loan. They live their whole lives off cheap loans backed by wealth they never sell, and they never pay income tax on any of it. This strategy even has a nickname: buy, borrow, die. And the die part is not a dark joke, it's the grand finale. Because when those assets pass to their heirs, a rule called the step-up in basis can erase an entire lifetime of gains for tax purposes, as if all that growth never happened at all. Bought, borrowed against, and handed down, with the tax bill simply vanishing at the very end. Put a real number on it. Someone sitting on $50 million in stock can borrow a few million against it at a low interest rate, spend every dollar of it, and owe the IRS nothing. Because on paper they earned nothing. No sale, no income, no tax. Meanwhile, you paid tax on your paycheck before it ever even hit your account. Lever number 3. Shrink the number you get taxed on in the first place. This is where deductions and depreciation walk in, and it's exactly why the wealthy are so in love with business and real estate. When you own a business, a whole universe of your expenses becomes deductible, coming right off the top before your tax is ever calculated. And real estate holds the crown jewel of them all: depreciation. The tax code lets a property owner deduct the theoretical wearing out of a building every single year, a pure paper loss, even in a year the building actually went up in value. So a real estate investor can collect real rent, watch the property appreciate, and still report a loss on paper that shelters their other income from tax. They get richer while telling the IRS they lost money, and it's completely legal. A landlord can show a loss on a building that just made them $30,000 in real appreciation and rent. On paper, a loss. In the bank account, a gain. It's not one giant trick. It's 100 small legal ones stacked on top of each other. Now, stack all of these together: deductions, depreciation, credits, retirement contributions, charitable structures, and a high earner can legally carve their taxable income down to a shocking fraction of what they truly made. So now here's the part I really need you to hear, because it is easy to walk away from this furious, and anger is the wrong lesson to take. None of this is a loophole, or a secret, or a scandal. Every bit of it is written directly into the tax code, on purpose, in broad daylight. Governments want people to invest, to start businesses, to build housing, to hold assets for the long term, because those are the things that grow an economy. So they wrote the code to reward exactly those behaviors and to tax the one thing that needs no encouragement at all: showing up and earning a wage, the very hardest. The system isn't secretly rigged against you. It is openly tilted toward owners. The only real trap is that nobody ever hands the wage earner the rulebook. So millions of people spend their entire lives playing the single highest taxed game in the code, never realizing there was another game sitting right beside them the whole time. Not hidden, just unread. So what do you actually do about this? Standing here as someone who is very much not a billionaire, you start moving yourself, $1 at a time, off the earning side of the code and onto the owning side. And watch how the exact same 3 levers shrink right down to your size. Lever 1, change what you're taxed on. Every dollar you move from your wages into investments starts working for you as low-taxed capital gains instead of high-taxed income. Lever 2, change when you're taxed. That is literally the entire point of a 401k, an IRA, and an HSA. They let your money grow without being taxed along the way, and some of it, in a Roth or an HSA, never gets taxed again. You are using the wealthy's exact defer the tax principle, just inside an account built for regular people. That is not a billionaire move. That is a Tuesday afternoon move that almost anyone can make. And lever 3, shrink the number. Take every deduction and credit you genuinely qualify for, use that HSA, grab the full employer match, and if you ever run a side business, learn what is legitimately deductible. You will never fully escape the tax on your paycheck. But every single year, you can shift a little more of your financial life over to the side of the code that was actually built to reward you. It's slow. It's a little boring. And it is exactly how the gap gets closed, $1 at a time. And to be crystal clear, because this genuinely matters, I am not a tax advisor, none of this is tax advice, and the line between legal avoidance and illegal evasion is one you never, ever want to cross. So sit down with a real CPA before you actually do anything. But the framework is the framework, and now you can finally see it. The wealthy are not necessarily smarter than you. They just learned early that the code quietly rewards owners and punishes earners, and they moved themselves accordingly, on purpose. So here's my question for the comments. Did anyone ever actually teach you the difference between earning and owning, or did you have to find it out the hard way like most of us? And which lever are you going to start pulling first? Tell me below. And if this pulled the curtain back even a little, subscribe, because every week we break down the money rules that the people winning this game would honestly rather you never learned.